The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Cho with Juliana Tattelbaum in London and Carolyn Roth at UBS headquarters in Zurich. These are your headlines.
UBS beats estimates when it comes to second quarter net profit, but the CEO Sergio Ermotti tells me that tariff uncertainty is hitting client sentiment.
People need to see the end game of all these discussions. A degree of stability and predictability on what's going on, so I can say that probably there is a little bit of a news fatigue.
Chinese and U.S. negotiators leave Stockholm without confirming the extension of a trade truce. As Treasury Secretary Scott Bessent tells CNBC, the final decision rests with the White House.
I'm going to see him with Ambassador Greer tomorrow, and he'll have the final decision. I think our Chinese counterparts have jumped the gun a little.
Kering sales slumped more than expected in the second quarter, with revenue at Gucci down by a quarter, as the French luxury group warns of a second wave of price adjustments in the wake of the EU-US trade deal. And a powerful 8.8 magnitude earthquake strikes off the coast of Russia, triggering tsunami warnings and evacuations stretching across the Pacific Ocean.
The news flow this morning very much dominated again by tariffs, and it's going to be a very big 72 hours. We've got first up second quarter GDP coming out of the United States. We're going to have the Federal Reserve decision and, of course, the July jobs report as we roll into Friday. In the meantime, a bunch of tech earnings as well. And right here in Europe this morning, UBS, one of the big banks, reporting.
A number of earnings to digest this morning. Let's kick off with those UBS numbers. UBS has booked $2.7 billion in second quarter underlying pre-tax profit, beating analysts' forecasts. Carolyn spoke to CEO Sergio Ermotti about the quarter and asked whether uncertainty around President Trump's tariff war is playing on clients' minds.
I would say it was a very, very strong quarter. If I look at PBT on an underlying basis for our core businesses being up 25% is a quite remarkable achievement. I'm very pleased also to see that in wealth management, all the regions had double-digit growth in PBT terms. Record second quarter results for our markets operation. Also good inflows in our unified alternative businesses with surpassing 300 billion of assets. So and also good momentum in Switzerland. We continue to sustain the economy and our clients with 40 billions of new loans or renewed loans. So across the board, I'm very pleased. Also, we are making good progress in the integration. A big milestone was achieved. We migrated 400,000 clients early in the second quarter, and in a very smooth way so far. So I'm very happy.
I want to come back to the volatility that very much benefited your global markets business. As you said, a record quarter there. How much of that volatility and that positive momentum were you able to carry over, given that we're a couple weeks now into the third quarter? What are you seeing?
Well, we don't really comment on ongoing quarters, but it's fair to say that it's quite the market levels we achieved. If you look at equity markets, they are up 30% from the bottom that we saw in early on in April. If you look at the activity level, is healthy, but it's not really reflecting a record high environment. So clients are still on a kind of wait and see attitude, not only institutional and private clients, but also corporate clients. So you see deployment of cash, but the conviction level is not there yet to the extent that it would make it more constructive.
What do you think would change that? Because we had a couple of deals come through on the trade front, the Japan deal, the EU deal. Of course, we're waiting for a few more. Do you feel like sentiment and deployment of capital is being held back by that? And do you see more conviction coming through now, just the last couple of days?
Well, people need to see the end game of all these discussions. So first of all, and a degree of stability and predictability on what's going on. So I can say that probably there is a little bit of a news fatigue. So every day there is a news, every day there is maybe the other way around of what you heard the day before. So you need stability and predictability of the environment. We also need to fully understand what all this tariff means. So we clearly can be very happy that a base case scenario has been achieved. So we believe that that's the least challenging scenario that is now playing out. But it's still 6 times higher tariffs than we had at the beginning of the year. So this is going to have an impact on consumptions, on inflation. If you think about from an exporter standpoint of view, being a Swiss or a European exporter, if you add up the tariff to the FX changes, it means that your goods are costing 30% more to a US consumer. So we still need to see exactly how this will play out.
And I think you make an excellent point here in the sense that it will impact the businesses you work with. What does it mean in terms of credit losses? What are you forecasting here? What have you put aside?
Well, for the time being, we still stick on our prediction that we're going to see around the same level of credit loss impairment that we saw last year. We are watching very carefully exactly what is the potential first order effect on our clients that are exporting directly to the US. But I still that nowadays you always need to think about the second order effect, what it means for the clients of your clients and the broader economy. So credit losses are a function of modeling economic forecasts and actual losses. So I think that the former has an impact on CLEs.
An important conversation there with Sergio Ermotti. Let's get out to Carolyn for more from Zurich. Carolyn, I thought it was fascinating how UBS is talking this morning about investors, companies just poised, ready to deploy, but just waiting for more conviction. But all the preparation that UBS is embarking upon to make sure they capture a slice of that deployment.
Absolutely. And we've seen all that weakness when it comes to LCM, that's leveraged capital markets. That wasn't just the case for UBS, but across the board in the banking industry. So once this conviction that Sergio Ermotti, the CEO of UBS, talks about, once that really does come back to the markets, we should be expecting that flurry of deals. But of course, this is something that Wall Street had been expecting since the start of the year. And then came all the tariff news. So with the deregulation kicking off in the US, there's a hope that this will hopefully spill over to the European side of the banking industry as well. But obviously, the elephant in the room when it comes to UBS had been the capital question. Early June, the Federal Council here in Switzerland has given out its capital recommendations as part of this updated too big to fail reform, and those were pretty dire. An extra $26 billion in capital is what UBS is expected to hold over the next couple years, over the next 6, 7, 8 years. That is a lot of money, even for a behemoth like UBS. And UBS at the time has called this excessive. Now, I spoke to Sergio Ermotti about this in terms of to what extent this could be watered down in the parliamentary process, to what extent it hits their business. He said the impact on the business isn't very big, but obviously he's complained a lot about the tougher regulatory environment that UBS is now facing with, but pretty much told me, hey, we need to stay close to the client. We need to invest in the future in our business. And really, it doesn't really have a choice in terms of just being continued in that parliamentary process in terms of the lobbying, which it has already done. When it comes to how the analyst community feels about UBS, Bank of America, for example, pointing out that this has been one of the worst performing banks in Europe year to date. It is up 10%, but a lot less than some of its peers, of course, saying risks are now well reflected in the share price, which will remain range bound at least until the year end when the new targets on share buybacks are due. So it's hoping to get back to the levels that it was at before the emergency takeover of Credit Suisse. But this is an ongoing story, and we won't have much clarity on the final capital level, the extra capital surcharge it is expected to hold for a few more years. Back over to you.
Carolyn, thank you so much for bringing that story to us. I think that is one of the big elements that you flesh out there about the stock price performance at 10% versus 60% we've seen from the likes of UniCredit. So very much a divide in the types of performances we've seen across European banks. But let's switch focus. We've got so many companies reporting this morning, Julian.
We do. Let's kick off now with the healthcare sector. We've got GSK numbers just crossing the wires here, and a strong result from GSK in terms of the numbers as well as the guidance. Q2 sales came in at £8 billion. That's up 1%, 6% CER. Specialty medicine sales up 15%, £3.3 billion. Vaccine sales, $2.1 billion. That's up 9%. In terms of core operating profit, which is a key metric for the company, that's up 12%. Core EPS up 15%, reflecting specialty medicines and vaccines growth. These numbers better than the market had been expecting in terms of sales as well as earnings. Now, in terms of the guidance, this was also encouraging here. The company is now confident around their 2025 guidance, and they're now saying that they expect to hit the top end of the range. They're increasing toward the top end of the range for turnover of 3 to 5%, core operating profit growth of 6 to 8%, and core EPS growth of 6 to 8%. Now, in terms of tariffs, they've also got a line here saying that GSK notes that the U.S. administration has initiated an investigation under Section 232 of the Trade Expansion Act to determine the effects on national security of imports of pharma products. Our guidance is inclusive of tariffs enacted thus far and the European tariffs indicated this week. So this guidance, they're guiding to the top end of their range. And this is inclusive of the latest news that European pharma imports into the United States will be hit with a 15% tariff. We are positioned to respond to the potential financial impact of tariffs with mitigation options identified. Given the uncertain external environment, we will continue to monitor development. So pretty fast-acting moves from GSK to incorporate the latest tariff news into their forecast. We're going to hear from GSK CEO Emma Walmsley later today. Don't miss that conversation at 3:15 London time.
In the meantime, luxury numbers crossing the tape today. MA's with numbers out this morning, and just digging into the detail, the revenue just looks a shade lighter than expectations. And 3.92 was the number that the market had been shaping up for, and the number crossing at 3.91 billion this morning on the revenue line. When it comes to net profit, at 2.25 billion for the first half. In terms of the lines here, and the commentary is fascinating, we're seeing no change of trend in China. Prices were raised by an additional 5% in the United States. So again, to the pricing power that this luxury giant still has. Global price hikes amounted to around 7% this year. No further rises planned. The company, I think if you look at some of the estimates too, for what it's seeing down the track here, the individual parts of the business are fascinating because the Asia business, ex-Japan, that was just plus 3%. Japan, though, by comparison, up 16%, and the America's up 12%. Charlotte here to break it down for us. It has clearly been an incredibly difficult time in the luxury sector. We're seeing it every different brand in the business. Amaze, in that context, seems to be holding the line just.
Yes, catering to the ultra-rich clients, a little bit more shielded from the slowdown that we see potentially with other luxury players. But we see, it is impacting them as well. They're not completely immune to the slowdown. Certainly still a similar picture to what we saw with Brunello Cucinelli a few days ago. There's still some growth there, so as you were saying, in the different regions. Actually, some improvement when they look at Asia Pacific, excluding Japan, in Q2 was up 5% against 1% in the previous quarter. Some interesting to see the comments that they don't see improvement in China, but certainly the overall region seems to be doing better. Looking at the Americas, up 12% in Q2. It was up 11% in Q1. So again, we see a positive trend going forward. When it comes to Europe, excluding France in Q2, was up 12%. So here again, it was 13% the previous quarter. So we still see some very strong growth compared to other luxury players. Looking at the different divisions there, we see leather and goods in Q2 up 15%. We had last week the results from LVMH, and their fashion and leather segment was down 9%. So you see a very different picture when we compare with Hermes. They're ready-to-wear and accessories 4%. Silk and textiles just up 2% in Q2. And that's interesting because we know that this is the most exposed to the aspirational buyer, buying a scarf, buying a tie. And this is the one that is having a slowdown there, that has the smallest growth. The other one, of course, watches, similar to the picture that we saw with LVMH and with Richemont. It is a sector that is suffering and is still down 5.5%. 2.5% in Q2. But otherwise, across the other segments, we still see some growth, and we see, while Asia is still difficult, some growth coming back as well. And interesting to see, as you were saying, the price hikes comments, and they've hiked prices around 7% this year. They won't increase more, but they have put an additional 5% in the US to offset the tariff effect.
Just a quick on the outlook statement, they threw in monetary uncertainties. That seems new to me. I don't typically see some of the ultra high net worths impacted by monetary uncertainties, interest rates.
Yeah, but it's interesting because with the US also the big beautiful bill, a lot of analysts say it's a positive for the richer individuals in the US. So that could be a positive for the luxury sector as well. So there's a lot of wait and see of what the situation means, how things unfold in September, particularly in the US.
This will be an interesting one to watch today, given the stock is up year to date, up more than 3% versus LVMH down 25%. So even though the numbers look pretty decent, clearly it's been a favored luxury name relative to the rest of the bunch. Charlotte, thanks for bringing us the breakdown. Now let's switch gears here. We are tracking a tsunami this morning. Evacuations are underway after a magnitude 8.8 earthquake struck off Russia's far east Kamchatka Peninsula. Japan has issued a tsunami advisory for much of its east coast, warning of waves of up to 3 meters. Fukushima nuclear power plant has been evacuated. Some Nissan plants have been shut down, and residents have been told to seek higher ground as authorities warn a tsunami could be expected for more than a day. Meanwhile, the U.S. Coast Guard has ordered all commercial vessels to evacuate harbors in Hawaii.
Meantime, President Trump will have the final say on whether a trade truce between the US and China will be extended, according to U.S. Treasury Secretary Scott Bessent. American and Chinese negotiators wrapped up their latest talks in Stockholm yesterday, the third round this year. Bessent and U.S. Trade Representative Jameson Greer are expected to brief the president today. Speaking to CNBC, Bessent also addressed the August 1st deadline for countries which have yet to sign a trade deal with the U.S.
It's not the end of the world if these snapback tariffs are on for anywhere from a few days to a few weeks, as long as the countries are moving forward and trying to negotiate in good faith.
Coming up on the show, a weaker than expected quarter for Kering as the luxury owner faces weakness at flagship brand Gucci. Plus, the IMF raises its global growth forecast but warns of continued tariff risks. And we'll get another check on the banking sector with Santander CFO Jose Garcia Cantera. That conversation is coming up after this. Welcome back to the program. Let's continue with earnings. HSBC reporting a 26% slump in first half pre-tax profit, missing analyst estimates as the bank took another multi-billion-dollar hit from impairment charges from its stake in Chinese lender Bank of Communications. Elsewhere in the banking sector, Santander posted a record net profit in the second quarter, coming in at 3.4 billion euros and topping expectations. The Spanish lender also unveiled a 1.7 billion euro share buyback program as it reiterated its full-year outlook. Well, for more on the numbers, Jose Garcia Cantera joins us now, CFO of Santander. Jose, always great to speak with you. Looks like quite a strong result for Santander, a 19% increase in EPS, record first half profit. Walk us through the highlights of the quarter.
Good morning, and thank you for having me on the program again. Very good quarter. I think this is proof that our model works. We have a very diversified business by countries, by regions, and by business. And some of the regions and countries are doing extremely well. More importantly, though, we were able to increase the number of customers by 8 million in the last 12 months. And we are doing more business with these customers. And this shows in the quality of the results. Record profits, up 13% in euros year on year in the first half, 18% in constant, in local currency, which is the true measure of how well the bank is doing. At the same time, very strong balance sheet, capital reaching 13% at the top end of our range, operating range, And value creation for shareholders, which is TNAV plus dividend per share, growing at 13%. Like you said, these first half numbers are very much on track to meet our year-end estimates in every single KPI that we communicated to the market.
With so much geopolitical and economic uncertainty overhead, we're tracking credit quality and credit losses quite closely this quarter. You have actually seen an improvement in credit quality. What do you pin that down to, and what are you planning for in terms of credit losses in the coming quarters?
The key variable to assess the future evolution of loan loss provisions as a quality is the strength of the labor markets. And in all the regions, countries where we operate, labor markets are very strong. Unemployment levels are at very low levels, and in some countries, they are actually coming down, like in Spain. So we see no asset quality pressure, and the outlook is very much stable. We guided the market for the cost of risk at 115 for the year. We are at 114 in the first half of the year, so very much in line with what we expected.
It has been a quarter marked by a ton of deal making, namely the big one being TSB and the acquisition here of the UK business, as well as the sale of parts of the business in Poland. Just tell us, when it comes to the UK, how that is going to add value to the UK operations.
The UK is a really important market for Santander. We have a large balance sheet of very low risk mortgages, very stable, predictable results in hard currency. And this helps stabilize the risk return profile of the bank. TSB is a bank with a very similar business to the one we have in the UK, which is mostly mortgages. So the integration is going to be relatively simple. We bought it at 5 times earnings post synergy, so very good price for us. And this is going to help accelerate our transformation program in the UK. And now we are targeting a return on equity of the integrated entity at 16%. So a substantial improvement relative to what we expected before. So we are very pleased, very, very pleased with the acquisition.
Jose, let me ask you too about the macroeconomic environment, because it seems readily apparent the more we speak to economists, and I was talking to the IMF yesterday, that the wash-up of the tariff threat could be a shallower pathway for interest rates, particularly now as it comes to the ECB. We may be in the final stretch in terms of some of those rate reductions. What does that mean in terms of profitability for the bank?
We have, as I said, a very diversified portfolio by regions, countries, businesses. Generally speaking, we benefit from lower rates. So we have positive sensitivity to rates in the countries like Brazil, etc. We expect the ECB to maybe to have one more cut, most likely towards the end of the year. And the Federal Reserve, 2 more cuts over the next 6 months, probably the first in September, and the second one between the end of the year, beginning of next year. So this is what we have built into our numbers. And the economic background remains very, very strong. Having reached an agreement on the tariff front in Europe, I think is positive in itself, because it eliminates months of uncertainty. So overall, we feel very comfortable, and the outlook looks very constructive for the bank.
I'm curious as to how clients are holding up, because what we've seen over the course of this year has been front-loading at the start to get ahead of the tariffs, and then some uncertainty kicking in. We're hearing this morning from the likes of UBS that they're poised already for clients and for companies to get going, with investors looking for some more conviction before they commit. What are you seeing in terms of your clients trying to navigate the tariff uncertainty?
Well, 70% of Santander is retail and commercial. This is SMEs, individuals, private banking. These segments are not very much affected by these macro conditions. We've seen some anecdotal evidence that some companies have postponed investment decisions, but again, it's anecdotal. I think the strength of Santander is the fact that we are a retail commercial bank, highly diversified, and countries that are doing very, very well independently of this whole thing about tariff and macro and geopolitical uncertainty.
Let's wrap up on the share buyback program that you announced today, a new share buyback program of 1.7 billion euros, 25% of the profit you recorded in the first half. And Anna Botín, your executive chair, saying in the release today, value accretive capital redeployment remains a top priority. What can investors expect in terms of returns moving forward, and how are you thinking about capital allocation moving forward?
When you look at the first quarter results, the increase in return on equity comes from the fact that we are investing the capital on our own business at a return on equity equivalent to 22, return on tangible equity at 22-23%. So the business itself, BAU, our own business, is yielding well over 20% return. So that is the key priority. In our capital hierarchy, the number one priority is invest on our own business. After that, obviously, we need to remunerate shareholders, and the last part of the capital hierarchy is to look for acquisitions, bolt-on acquisitions. But again, this comes after having invested on our own business. And today we have great opportunities to invest the capital in the businesses that we have, again, at over 20%, for instance, in the first half. So going forward, we expect to meet our year-end target of return on tangible equity post-AT1 at 16.5% and continue improving profitability in 2026 and 2027.